Hey everybody, Smart Silver Stacker here. Hope you're doing well. Inflation is continuing to rise, and it is going to become a much more persistent problem than we have been led to believe. Yesterday, the January CPI data was released, and surprise, surprise, it was hotter than expected, with month-over-month inflation hitting 0.5% and the annual CPI at 6.4%. Now, that is against expectations of 0.4% and 6.2%, respectively. And the reaction of the precious metals to this news has been to the downside. We did get a small sell-off yesterday when these numbers were announced. Basically, gold and silver were flat following the news. They were slightly in the red. But today, at the time that I'm recording this video, both metals are selling off. And we can take a look at the charts courtesy of SD Bullion, and you can see that gold has now fallen below the 1850 level, and silver is back under $22 an ounce. And if you ask me, both metals, gold and silver, may have a bit more room to fall before we see a rally. And we're going to get into why they are reacting this way to the inflation data, and also how this inflation situation is likely to continue to play out as we make our way through 2023. And it might not be what you expect, so stick around. Today's video is brought to you by Silver Botanicals line of household and personal hygiene products powered by Nano Silver. You can check them out with the link down in the description, and make sure you use coupon code STACKER to save 10% on your order. So why are gold and silver dropping when inflation is headed higher? Well, the answer is simple, really. We still have this bizarro Fed-driven marketplace in which the words that come out of one central banker's mouth, and I'm talking about Jerome Powell, are more important than all the fundamental factors in the global economy put together. I mean, think about that. Markets hang on this guy's every word, and more than that, they hang on the expectations of what his words will be. That is what we are witnessing right now. According to the CME's FedWatch tool, following this hot inflation print, markets are now beginning to price in the possibility of a 50 basis point rate hike at the Fed's next FOMC meeting, which is scheduled to be held on March 22nd. And I do think that markets are right to anticipate a more hawkish stance from the Fed in response to this data. Powell has made it very clear that Fed policy will be data-driven moving forward. And that's fine. I mean, keep in mind that all the data is pretty much rigged and controlled anyway, but when the CPI comes out hotter than expected like this, it is likely to impact Fed rate hiking policy moving forward. And as a result, markets are reacting negatively in light of the higher inflation print. It's a weird dynamic. I mean, you'd think, okay, inflation is going higher, asset prices and commodity prices like silver, those should be going higher as well. But the fact is that for more than a decade, the Fed has been pumping tons of liquidity into this system. They've been inflating massive asset bubbles. They've been creating all sorts of debt, leverage, and malinvestment throughout the economy. And now these markets are addicted to the Federal Reserve's printing press. And so the Fed, they're really the only game in town now. We don't have any kind of real price discovery in these markets. And these bubbles, they're going to have to pop before we get that again, that real price discovery, that is. And I would still be a little wary here, even though we have already seen a bit of a pullback in the precious metals. If you checked out my video on Monday, you know that I was forecasting a hotter than expected inflation print, and we did get that. But I also forecast that we would get a sharp sell-off in the metals and the markets, and that has not manifested itself yet. So, we've seen a drop, but I'm still sitting on the sidelines. Who knows, right? Short-term market timing is extremely difficult. The metals, silver included, it could take off at a moment's notice if we do get some kind of unexpected dovish talk from the Fed, or, perhaps if we get some sudden economic calamity and everyone starts looking for the exits and rushing into safe havens. But barring an event of that type, I do think that this sell-off may have a bit further to go before we hit a bottom, and we'll probably know by the end of this week. Now, the reason I am convinced that we will be seeing a more hawkish Fed very soon is because the Fed's whole disinflation narrative that we've been hearing so much about lately, it's starting to look pretty shaky. Last week, before we even got these January numbers, the BLS revised 4 of the previous 5 months' CPI prints to be higher than were originally reported. And now we've gotten this hotter than expected print for January, and I know that, personally, I don't see falling prices when I go out shopping. You can leave me a comment down below to let me know what your experience has been with inflation, but as far as I can tell on an anecdotal level, everything is still getting a lot more expensive. And this whole disinflation thing, Powell mentioned it something like a dozen times at the last FOMC press conference, but to me, it seems like a bunch of nonsense. And not only is inflation beginning to tick back up, there are ample signs out there that rising prices are going to continue to be a major problem throughout 2023. And I'm not just talking about all the money printing that's still going on to finance the deficit spending in Washington, although, of course, that too is going to contribute to the issue. But what I'm referring to is the global energy supply situation and the disruptions thereof, which, although, they're not getting a lot of attention at the moment, everybody's kind of distracted looking at these balloons or UFOs or drones, kind of a look over here, not over there sort of thing. Global energy supplies are getting a lot more disrupted, and they're likely going to be contributing to much higher prices across the board in the very near future. Just keep in mind that a big part of the reason that we saw inflation beginning to tick down at the end of 2022 was due to the release of nearly 300 million barrels of oil from the Strategic Petroleum Reserve, which has now been drained by almost half. And of course, that's a trick that you can only pull off at most, twice, right? Because then the SPR doesn't exist anymore. It'll just be a bunch of empty storage facilities. And those sales, by the way, they didn't end in 2022. Another 26 million barrel sale from the SPR was just announced. And the price of oil has once again declined as a result. But again, this is not a sustainable way to fight inflation. Eventually, the SPR is going to run out. And that's going to come sooner rather than later at this pace. And then not only do we not have a reserve remaining for a real emergency, not an emergency of approval numbers, but like a real crisis of some sort. And I don't know, gosh, what could that look like? You'd think if you're headed into World War III, you might want some oil reserves, just in case, but that doesn't seem to be a priority at the moment. But when the SPR is completely depleted, or, when they halt the sales, because one way or the other, that day has to come soon, the downward effect on inflation that has resulted from this infusion of energy into global markets will be no more. And on top of that, Russia recently announced production cuts of 500,000 barrels of oil per day. Now, Putin, he's been warning the West for a long time that production cuts would be the response to Western sanctions. And now he's following through with those threats. Basically, he has weaponized global inflation because he knows that the U.S. wants to keep global energy prices as low as possible to help with domestic inflation, but Putin has other plans. Now, 500,000 barrels of oil per day, that represents about 5% of Russia's total production. So even with these cuts, they're still going to be able to earn some revenue, and they've also got room to cut further if they so choose. But just think about these cuts in terms of the U.S.'s ability to respond. We're selling another 26 million barrels of oil from the SPR, and that does what? It eliminates the effects of these cuts for a whopping 13 days. Russia, they can sustain lower production for much longer than the SPR can sustain these sales and releases of oil. That much should be obvious. And that 500,000 barrels of oil per day that Russia is cutting out of global supply, it's not going to get made up by other producers either, because following that announcement of Russia's surprise cuts, OPEC Plus told Reuters in an interview that they had no plans to alter their production targets in response. And on top of that, OPEC's latest monthly oil report that was released yesterday revealed that Saudi Arabia, the world's top oil exporter, slashed output by 156,000 barrels of oil per day from December to January. And with U.S.-Saudi relations still near a multi-decade low, you have to wonder about the motivation for this decline in production. Now, of course, higher oil prices do benefit the Saudis. If oil goes up in price, they're going to be selling their oil for a bigger profit. But we also know that back in December, Saudi Arabia and China established a new strategic partnership. And according to an interview that was published on Sunday by the Russian Sputnik news agency, the Russian ambassador to Saudi Arabia, Sergei Kozlov, he just told us that Moscow and Riyadh are headed in the same direction. Now, that shouldn't come as any surprise to viewers of this channel. We've talked quite a bit about the possibility that Saudi Arabia may be joining the BRICS organization, possibly as early as this August at the 2023 BRICS summit in South Africa. We know that the expansion of BRICS is going to be a priority at that summit. That's what the South African ruling party has been telling us. So, the whole petrodollar system, folks, it's in danger. And at the same time, the global energy supply is shrinking. And don't forget, the federal government is still spending money hand over fist. And also, we're embroiled in a global conflict that is looking more and more like it's going to turn into a full-fledged World War III. So, for all of those reasons, inflation is going to be headed much, much higher. And the Fed probably will be getting more hawkish, and that might come as early as next month's FOMC meeting. We might see a 50 basis point rate hike at that meeting at the end of March. And so, we may see markets and commodities continue to come under some pressure in the short term. But I just view that as a buying opportunity. And the reason I'm still very bullish on gold and especially silver in the medium to long term is because ultimately, to whatever degree the Fed does pursue a tighter policy, it's only going to hasten the day when something in this massively over-leveraged economy breaks. And that's going to be something that can't be ignored. So when that happens, I think all hawkishness will be forgotten and the money printing is going to resume. Everything that the Fed has done for the past 2 decades plus indicates that this will be the path that they choose. Now, don't get me wrong, there may be some pretty massive pain before the Fed eases or pivots or, prints the dollar to oblivion, whatever you want to call it. But I do believe that that day is coming. And when the unemployment and crashing asset bubbles force the Fed, and, I say force, this is going to be their narrative, not mine, to intervene and print like never before, all thoughts of fighting inflation, they're going to go out the window. And when that time comes, I hope that you've got some real money, not just digital fiat tokens in an online account somewhere, and not paper, gold, or silver either. I'm talking about the real, physical, tangible metal that you can hold in your hand, because the next round of stimulus, it is going to bring on inflation hot and fast like we have never seen before. And that is when I suspect that investors will be getting a rude awakening into the nature of paper assets. And this stuff right here, this may be a lifesaver. Of course, none of this is financial advice. I'm not a financial advisor. I'm just sharing my thoughts with you. And as far as capitalizing on the drop that we are now seeing in the precious metals, one thing I am taking a look at once again is 90% constitutional US coinage, because premiums on this stuff have come down in a very big way recently. SD Bullion now has rolls of junk silver coins for under $18 per $1 face value. Now that's just slightly higher than a 13% premium over spot. And if you compare that to last year, the silver price back then was actually lower than today, but these coins were more expensive. The premiums were up, I think, around 60% at the peak. So, now these old US 90% silver coins are affordable again, and I'm going to be considering them for any bullion purchases that I make, because I think that the day will come when the premiums on junk silver go way back up. But what about you? Are you stacking on this pullback, or do you think that the metals still have a bit further to drop? How do you think the global energy supply is going to impact inflation as 2023 plays out? Leave me a comment down below to let me know what you think. Thanks for watching, everybody. Stay safe and happy stacking. Smart Silver Stacker